Lessons from the 1929 stock market crash. Imagine watching your life savings vanish overnight. The panic, the fear, the uncertainty. Now, imagine knowing a secret, a strategy that not only protects your wealth, but allows it to grow even in the darkest times. Stay with us, and we'll reveal how intelligent investors survived and thrived during the 1929 stock market crash, and how you can apply these lessons to safeguard your investments today. Welcome to Nouveau Riche Investor. Today, we journey back to one of the most tumultuous periods in financial history, the 1929 stock market crash. We'll uncover what happened, how intelligent investors navigated the chaos, and the timeless lessons we can apply to our own investment strategies. The Roaring Twenties was a decade of economic prosperity and speculative frenzy. Stock prices soared to unprecedented heights, driven by optimism and the belief that the good times would never end. But beneath the surface, danger was brewing. By late 1929, the stock market was overvalued and speculation was rampant. On October 24, 1929, Black Thursday, panic selling began. The market crashed, wiping out billions of dollars in wealth. The impact was devastating. Banks failed, businesses collapsed, and millions of people lost their jobs and savings. It was the beginning of the Great Depression. Yet, amidst the chaos, some investors not only survived, but thrived. How did they do it? By adhering to timeless principles that are as relevant today as they were back then. Benjamin Graham, often called the father of value investing, laid the groundwork for these principles. He taught that investing should be based on careful analysis, intrinsic value, and a margin of safety. Intelligent investors like Graham avoided speculation and focused on the fundamentals. They sought out undervalued stocks, companies with strong balance sheets, stable earnings, and solid dividends. They understood that the market's irrationality could be an opportunity to buy quality assets at a discount. One of Graham's key concepts was the margin of safety. This means buying stocks at a significant discount to their intrinsic value, providing a buffer against market volatility and errors in analysis. Graham also introduced the allegory of Mr. Market, a manic depressive character who offers to buy or sell stocks at different prices each day. Intelligent investors learned to take advantage of Mr. Market's mood swings, buying when prices were low and holding steady when prices were high. The lessons from the 1929 crash are clear. Avoid speculation, focus on the fundamentals, and always invest with a margin of safety. By following these principles, you can protect your investments and even find opportunities in the midst of market turmoil. Today, these principles are more relevant than ever. Markets are unpredictable, but by investing wisely and maintaining discipline, you can navigate the ups and downs with confidence. In conclusion, the 1929 stock market crash taught us valuable lessons about the dangers of speculation and the importance of intelligent investing. By focusing on intrinsic value, maintaining a margin of safety, and staying disciplined, you can build a resilient portfolio that withstands market volatility. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.